Hi, everyone. Thank you for joining us for our monthly webinar series. My name is Darren McHugh. I am with DTC. We are a dental IT firm out of Fallston, Maryland. And we have been going through our monthly series and bringing all different topics to you all with different strategic partners and partners that we trust. This month we are diving into accounting. So last month I know we hit the letter of the law with Phil, and this month we're going to dive into accounting with Sam Luxenburg. So we're excited to get started. Sam, I've known Sam for a little bit. Sam's been in business and practicing accountant for 12 years, servicing, gosh, well over 50, 60 dental offices. Representing the dental practices from the area, born for, gosh, 30 years or so, right, Sam? And
Correct.
we're excited to have him with us. Again, we really appreciate the partners' time. They are doing this just purely out of the kindness of their hearts, donating their time to share the different knowledge that they have. We have been getting a lot of inquiries about accounting questions and things like that, if we know any good references. Again, I tell all of our clients and people that we know, certainly reach out to Sam and his team. They are definitely the accounting agency, accounting firm to work with for the dental needs. Couple of housekeeping items before we get started. As always, we are going to have our presenter give the topic, hit their key points, and bring us their knowledge. At the end, we'll do a Q&A. Typically, we do try to give about 15 minutes for question and answer, sometimes a little shorter, but we all know that everybody is doing this during their lunch, or most of you are doing this during your lunchtime. So we want to keep it concise and within those time limits. The webinar will be available for viewing afterwards, as it is a recorded webinar. You can go online to our website at www.dtctoday.com and view the ones that we've done in the past. We've got topics ranging from marketing to practice build-outs to patient communications to HIPAA, financing, pretty much everything you can think of. The genesis for the webinar series was we had some clients continuing to ask us about referrals that we could provide to accountants, lawyers, marketing agencies, lenders, and we realized that being in this industry for 20+ years, we have built up a great relationship with reputable companies, and we just wanted to make sure that our clients and our community was aware of these really solid companies. We trust them. We use some of their services when applicable, and are glad to have them on board. So, without any further ado, I'm going to turn this over to Sam. And again, everyone is in mute right now, so if you have a question, there's a little question poll box that you can go ahead and click. Type in your question. We'll see your hand raised. And we'll either answer during the seminar or thereafter. Sam may open up the floor to questions as well. This is going to be sort of a informal webinar, as we just want to get you guys as much information as possible. We know that the topic, choosing an entity, is certainly an important one. With that, Sam, I'll turn it over to you, and I'm going to go ahead and give you control of the screen here. So just give me 1 second. And we'll switch it over. All right. Actually, Sam, before I do that, why don't we go ahead and, my apologies, well, let's go ahead and read through the agenda that we have. So let me go ahead and pull that up for you. All right, go ahead, Sam. Take it over.
All right, thank you, Darren. I appreciate it. Thank you very much, everybody, for joining today and for taking your time to listen to me. Hopefully this benefits you. From my experience, it's been a benefit to anyone that I've presented it to, and I hope that continues. Don't have a ton of slides to show to you today, but I do have a case study, and Hopefully that will lead to meaningful, I would say discussion, but since we're not face-to-face, meaningful information, and hopefully will provide an opportunity for you to ask questions to me, whether online or offline. Just a few topics that, as highlights that I wanted to discuss today. The first one would be exploring the different entity options. Many of you are familiar with a lot of the entities that are out there, but maybe aren't familiar with what they really mean and what they represent from a tax standpoint. Second would be the reasons to choose a specific entity. Next, requirements of an entity. After that, tax ramifications of an entity. We'll have a Q&A session after that, like Darren discussed. And then one thing which kind of came to fruition after we had already scheduled the webinar, and it's kind of a bonus. As many of you may know, that a week ago today, they came out with the proposed tax bill, which is a sweeping, I wouldn't say overhaul, but a sweeping change to the existing tax code as we know it in many different areas, and with a lot of specific changes that that affect just about every taxpayer. So I wanted to, not do an exhaustive overview, because that's virtually impossible since the bill is over 400 pages, but just some of the highlights that will affect probably everybody on this phone call, on this webinar. With that being said, I really just have the presentation is relatively simple, and I have a Word document that typically when I give this presentation, I do it in person. So it's really a case study that I hand out. Some people can, hold it in their hand and read it for themselves. And what I've done is I've just pulled it up on my screen, and you can read it. I can read it along with you. And at different points, I'll explain this is more of a summary. I'll explain the background information and how the mechanics of all of this work. So typically when I present this, I present it to younger dental practitioners, some of whom haven't even graduated school yet, but I find that it's better, and some of you may have learned this the hard way, it's better to have the proper foundation for setting up a prudent tax structure than later on in the game learning the hard way that you should have had a certain setup from the beginning. Many of you have, like I said, experienced this. Some of you have not, but depending on where you are in your career, may face this at one point or another. Many of you are very familiar with the different tax entities for a practice. The two basic ones are a limited liability company and the S corporation. I'd imagine that most people listening to this have heard of those two entities. Without getting into the legal reasons for for opening up one of those two entities, I'll leave that to the attorneys. But essentially, they provide you, each one of those provides you with virtually identical legal liability protection. Now, again, that's something that should be discussed with an attorney. But typically, from my understanding, after discussing this with multiple attorneys, is that each one provides the same level of legal liability protection. With that being said, there are tax ramifications for having each one of those entities. And although some of you may have started an entity with an idea of having that legal liability protection, you may not fully understand the tax ramifications of each entity. And even if you're using the entity properly, and as we go through the case study, I'll show you my opinion. Again, this is not absolute. This is my opinion of how an entity should be chosen and used effectively. Many of you may have this already in place, but either A, may not be using it correctly, or B, even if you are using it correctly, you may not understand the reason for having that entity and why it's structured that way. So even if it's just accomplishing that purpose, that you now understand why you have this entity and why you're using it in a specific way, I would say that it's a good use of your time. So as I mentioned when I first started, I typically give this to young practitioners who are just out of school and are in their first job. So the case study is set up for those for people in that point of their career, but it's really appropriate for anybody in any stage of their career. And I've had clients who have come to me, been practicing for 20, 30 years, and they're in an entity, or even not in an entity. We'll call it, they're in a tax structure that doesn't really make sense from either the liability standpoint and certainly not from a tax standpoint. So with that being said, I like to just kind of read through this, and then after each paragraph, maybe give a little explanation, because obviously if I wrote everything out, it would be a number of pages. So you have an individual who has recently graduated dental school, and they're ready to start paying back their education loans while practicing dentistry as a side job. I have so many individuals and clients who come out of school and they have a tremendous amount of student debt, and part of the difficult balance is managing that debt while paying their income taxes. And invariably what happens is that, they, between rent, mortgage, whatever it is, and student loans, what happens is they get to the end of the year and they have no money left for taxes, which puts them behind the 8 ball right from the very beginning of their career. So it's always important to have good representation and to get a professional involved at the beginning, so you don't get into a situation where you're working from behind the 8 ball. So an individual has been offered a position as an associate at a prestigious office and will be paid as an independent contractor. The compensation is tantalizing, especially if anybody has been an independent contractor before and is receiving a 1099, especially because there are no taxes being taken out of the paycheck, and Uncle Sam doesn't even know you exist yet. You sort of remember that at the last family get-together, your brother-in-law's uncle, who was a CPA, was rambling on about potential pitfalls of filing as a Schedule C as a sole proprietor, or even as a single-member LLC. But the event had an open bar, and you have very little recollection of the conversation. Now, some of you may be set up as an LLC. An LLC is great for liability protection, but unless if you have a single member, meaning one person in their own LLC, it's what the IRS calls a disregarded entity for tax purposes. Basically, that entity just files the same way a sole proprietor would file. They file on Schedule C. Now, there's nothing wrong with that, but a Schedule C, a self-employed individual, even if they're in a single-member LLC, they're subject to certain taxes that in a different entity, in a different structure, they would, for all intents and purposes, be subject to some of those taxes, but not all of them. We're going to get into that in a couple of minutes. So many dentists are employed as independent contractors and do not realize the potential downside until it's too late. By the time the mistake is made, it's too late to correct that, and the biggest credit agency in the world, the IRS, has another unnerved client. Now, anybody who's come out of school, or really at any point in their career, has applied for an associate position at a practice, many times the owner of the practice want to pay them as an independent contractor. Now, the reason the owner of the practice wants to do that is because the owner of the practice saves money by not having to cover the payroll taxes of the associate. Now, if any of you have been in a salaried position before, you'll clearly notice that the net paycheck you receive on, say, a biweekly basis is a whole lot less than the gross paycheck. The reason for that is because not only they take out federal and state income taxes, they take out Social Security and Medicare taxes as well. Now, when you're a salaried individual, whether that's in dentistry or any other field, the employer is responsible for 1/2 of the payroll taxes. They're responsible for 7.65% of the pay as payroll taxes. and the portion of that is Social Security and a portion of that is Medicare. And the employee is responsible for the other half. So between the two of them, the employee and the employer, they're responsible for 15.3% of the gross pay. So in a situation where an individual was taking salary or being paid a salary of $100,000, that would cost the employer $7,650 in payroll taxes, and the same number the employee would pay. Now, if you're being paid as an independent contractor, it's the responsibility of the independent contractor to pay both halves, and the employer doesn't have to pay anything. Now, without getting into the rules of employee versus independent contractor, because that's probably a separate webinar, if a person is being paid as an independent contractor, it's in their best interest to try to mitigate the cost that they have to cover for payroll taxes. Payroll taxes can also be known as self-employment tax, which may be a familiar term to most of you who are listening. S corporations, or subchapter S corporations, produce several tax benefits as compared with sole proprietorships or even single-member LLCs. The big benefit is that people usually, and most people know about this, is the payroll tax savings, which can be fairly significant. Now, to understand how this works structurally, let's compare two options: a sole proprietor or an individual who's in a single-member LLC, and an S corporation, both of which are making $150,000 a year. Now, just as a caveat, I list two figures here as tax expense. There's income taxes and self-employment taxes. Now, income taxes are very, very subjective. You know, I've never seen two tax returns that were exactly the same. So in terms of income taxes, I do list a figure here, but for each individual, their income taxes and their income tax rate at which they pay would be different. It depends on family size. It depends on you know, deductions, whether or not you're a homeowner or not. There are various items that play into a person's tax liability. But for this case study's purposes, I used roughly a 25% federal tax rate. Now, the income taxes that a sole proprietor pays depends on his or her filing status, itemized deductions, family size, and myriad of other factors, but typically this person would pay about $37,000 in income taxes. Now, in addition to the income taxes, the sole proprietor or an individual who's in a single-member LLC, because as I mentioned before, the individual who's in the single-member LLC is treated for tax purposes, not liability purposes, but tax purposes. They're treated the same way as a sole proprietor. They would have to pay a 15.3% self-employment tax, which is, as I mentioned before, the same as payroll taxes, on roughly $127,000 of their income, but only 2.9% on the remaining $22,800, meaning they would pay a total of $20,000 in self-employment taxes. Now, that's in addition to the $37,000 in income taxes that they'd be paying. So when you put the two together, it's a very, very significant number. Now, things work differently in the S corporation. To make our calculations easy, assume the S corporation is owned by one person, and that person is the dentist. In this case, the S corporation has to break the $150,000 into two categories: wages and the leftover, which is called the distributive share. If the wages equal $90,000 and the leftover distributive share equals $60,000, remember, I'm breaking the $150,000 that the S corporation makes into two portions. The business pays Social Security and Medicare taxes only on the salary, only on the $90,000, which is equal to about $13,800. Now, on this spreadsheet, I break it down. I break down the numbers, and basically, we have an individual who is a Schedule C, and that includes both a sole proprietor and somebody who files as a single-member LLC. The income is the same in both scenarios, Schedule C or S corporation. The income tax liability is the same, but the major difference is the self-employment tax. The individual who is in the single member LLC or sole proprietor pays $20,000 in self-employment taxes, while the individual who's in the S corporation has the ability to only be subjected to let's say $14,000, roughly $14,000 of payroll taxes or self-employment taxes, for a pretty substantial savings of about $6,000. Now, let's get into some of the details of the S corporation. The S corporation is an entity that treats the owner much like they were an employee. Now, the owner does have the ability to take draws, but they are required to pay themselves a salary. So in this scenario of a dentist making $150,000, I broke down that income into two categories. The salary, which is at $90,000, and on that amount, they would pay self-employment tax or payroll taxes, and the other $60,000 they don't pay self-employment or payroll taxes on. Now, that's in contrast to the sole proprietor or the single member LLC, where they would pay Social Security and Medicare, meaning payroll taxes or self-employment tax, on the full $150,000. Now, I get a lot of questions from individuals who already have established an LLC, and they say, well, I'm already an LLC, I don't want to start a whole new entity and then change the name and the tax ID number. Well, that really isn't required. There is an option to change the status or elect the status and be treated as an S corporation, even if you're an established LLC that's been around for a number of years. And as a matter of fact, you can even retroactively elect to be treated as an S corporation. So say you were in a single member LLC now, and you wanted to make a switch to an S corporation. You can elect to retroactively be treated as an S corporation back to the beginning of 2017. You don't have to change the entity name. You don't have to change the tax ID number. It's simply an election that gets made with the IRS, and it's pretty much a rubber stamp election. So you send in the form, and I've never had a request that was denied. Other than the payroll tax savings or the self-employment tax savings that exist in an S corporation, there are certain, I would say, intangible benefits that an S corporation has over a single member LLC or being a sole proprietor. One of which is that it's statistically shown that Schedule Cs are the most audited form by the IRS, as opposed to S corporations, which are audited much more infrequently. Again, it's an intangible benefit, but it's also something to consider, when deciding how you want to structure the entity that you're going to use for your dental practice, or even if you're just even if you're an associate and you're receiving a 1099 and that's the sole source of your income and it's a substantial amount, it usually pays even if you technically don't have your own practice, meaning you don't have your own brick and mortar practice. But being that you're an associate and you're an independent contractor, technically you do have your own practice. It's just not a brick and mortar practice. So I have many individuals who come to me in the associate category who are receiving a 1099, and we start them in S corporation and structure it so that they have a savings there for payroll taxes, for self-employment taxes. It's also beneficial in terms of putting away into retirement and many other things, but that's kind of outside of the scope of this discussion. I would at this point open it up to any questions that anyone might have. If you're not comfortable asking it online or whatever, you're welcome to contact me offline as well. But I would open it up if anybody has any questions.
All right. So if anybody does have any questions, there's a little box that you can go ahead and write it in. We'll take them as they come in. So far, no questions as of yet. So I guess, Sam, that means that you're explaining everything so well that they've got all of it.
So. Yes, I wasn't clear enough, so they're just confused. But I would say that it's complicated. It is
Yeah.
complicated. I try to simplify it as much as possible. A lot of times it's very difficult to understand how the entity works. The entities that I've discussed, LLC and the S corporation, they're pass-through entities. So the business itself does not pay any taxes. It's all passed through the individual, and that's regardless of whether or not they pull the money out. So a very common question that I receive is, hey, I made $200,000 this year, whatever the number is. I only pulled half of it out of the business. Why am I being taxed on it all? And the answer is because it's a pass-through entity. And whatever the business earns is looked at as if the individual earned it himself. I mean, technically that is what happened. Now, whether or not they choose to pull it out, that's their prerogative. But the way the IRS views it is that since these are pass-through entities, the entire income is passed through to the individual, and the individual reports that income on his or her tax return and is subject to the tax liability on the full amount of income. So again, I didn't cover all I covered as many of the details as I could without getting too nitty gritty, but I certainly get a lot of questions about some of the finer or more technical mechanics of how these entities work in terms of them affecting the individual owner's tax liability.
Gotcha. Okay. Got a couple of questions for you. One that came in, it says, if looking to work for another doctor and then buy them out, is there a certain entity that's better for practice purchasing?
So typically when we have an entity started up for any individual who's looking to eventually own a practice, we start them off as an LLC. LLC is, I want to say, a less formal type of entity. The corporation is a little more rigid in certain requirements, and a lot of that has to do with the legal protection. Everybody's heard of piercing the corporate veil. Well, the corporation seems to have more requirements than the LLC, so we typically would start them in the LLC. And as I mentioned before, the LLC has the ability to choose to become an S corporation when and if it becomes appropriate, and usually at some point it does become appropriate. So I have very few clients who are just operating as standalone or typical traditional LLCs. They typically at some point elect to be treated as an S corporation, and that's how that's the entity I would choose to start with, the LLC, and then when the time is appropriate, it can elect to be an S corporation.
Okay. Next question for you. It says, in the case that you discussed, would the remaining $60K profit be subject to the corporate tax rate?
No. So I didn't want to get into C corporations. C corporations pay their own taxes. Pass-through entities such as LLCs and S corporations do not pay their own taxes. So the business does not pay taxes. It pays payroll taxes, it pays personal property taxes and things like that, but it does not pay any income taxes unless it's a C corp. And I've only seen like one dental practice as a C corp, and it's probably because it was started in the 70s. So, the C corp is typically used for companies that are looking to go public, but dental practices are just about always S corporations or LLCs that have chosen to be treated as S corporations. And the $60,000 would not be taxed within the entity. It would be shown on the individual owner's return, and they would be taxed at their personal income tax rates, after applying all applicable deductions.
Okay. Next question. They are rolling in now, Sam. So next question is, I'm considering buying in as a partner to an existing practice. Do you have any guidelines of entity that you can discuss?
It really depends. That's kind of a little more involved because it depends as to whether they might be buying into an existing entity. So if that's the case, they would likely be buying it as an individual. and wouldn't and they'd be under that existing entity. So if they're buying into ABC Dental, they'd now have an ownership stake in ABC Dental, so they'd be part of an already existing entity. It's kind of hard to answer that without seeing the particulars of what's going on in that situation, but typically they'd be buying into an existing entity. They wouldn't have their own entity necessarily buying into the existing entity. They themselves would be buying into that entity.
Okay. Um, One of the questions, you got a big thank you for that, by the way, for answering that question. So one of the questions that I hear, we see a lot of new startups, and we're helping practices do build outs there. Most of the time it's hanging their shingle for the first time, going out on their own. Where would you advise these doctors to start? Well, like, what's the first step that they need to consider when looking at the whole accounting side and choosing an entity side? Where do you think that they should start?
I mean, they should always have a qualified professional. I mean, whether it's an attorney, whether it's a CPA, from the beginning, look and evaluate the situation. I get a lot of I read online or I heard from a friend. And a lot of times the things that I hear have some shred of truth, but they usually don't tell the entire picture, and it's certainly not anything to necessarily act on. Even if you think it's being constructive. So it's usually a good idea to get a professional involved, or maybe even if you're not interested or you don't have the budget to get a qualified professional involved. By the way, usually it does pay in the long run because you don't have to correct mistakes, but at least lean on somebody who has been there and done that, and is established, so they know kind of the ropes to at least give you some kind of guidance. But it's very important to have these kind of conversations in the beginning, because if it gets too far along in the game, it does sometimes become difficult to change the names on things, and being going to the insurance companies and getting credited with the insurance companies, that to change all that around later on in the game sometimes becomes difficult. So I would just suggest, like, anybody who's going out on their own or hanging, like you said, hanging their own shingle, just make sure they have all their ducks in a row, or at least most of their ducks in a row from the beginning.
Okay. All right. I don't see any other questions coming in. Sam, I'm going to go ahead and pull back the presentation. I want to make sure that everybody can see your contact information.
Okay.
So it should be up on the screen now for everyone to view. Sam, can we go ahead and just invite anybody who's on the webinar now or visiting down the road to contact you, either the information you have here, reach out. I'm sure that they're going to be additional questions, and I'm guessing it would be okay if they reach out to you directly.
Sure. Yeah, that's fine.
Okay. Any final points or anything else?
No, I mean, I don't know if we have time to give a quick overview of some of the highlights. If we do not, then I would just say, there are plenty of good, decent websites out there, some of the more reputable ones, whether it's, Bloomberg or CNN or whatever it is, that have some of the highlights of the proposed tax bill that will affect most people. I mean, there are some finer points that are very technical and will apply to a few people, but
no, we definitely have a few minutes left. If you've got time and to share, we can do a little bit of the highlights. That'd be great.
Yeah, absolutely. So I would just start with I would preface by saying that the bill that came out last Thursday was very far-reaching, and it really is going to affect a lot of different people in a lot of different areas. But it's a proposed bill, so you already hear the rumblings about whether or not it's going to get through the Senate. And as a matter of fact, it looks like the Senate might be coming out with their own bill. So besides the 429-page bill that Congress put out, the Senate might come out with their own bill. And I imagine it'll be built on their bill, but just have either additions, subtractions, both. Is yet to be seen. nobody knows when exactly this will be passed, but for the time being, they had talked about people being able to file their return on a postcard or postage stamp or whatever they said, unless they like really make those postcards or postage stamps incredibly huge. It's not happening anytime soon because while the bill did simplify certain areas of the tax code, it definitely doesn't simplify the tax code in general. The main area that people are gonna feel the change in are the actual rates, the brackets. Um, they did simplify that area in terms of lowering or lessening the amount of the number of brackets that exist. So under the previous or under the current bill, under the current code, there are 7 different brackets, and it's confusing. It's very confusing to try to figure out what rate you're paying because you might fall into every one of those brackets because they're tiered. They're not, all your income doesn't get taxed in one bracket. It gets taxed in numerous brackets depending on how much you're making. So this cuts down the number of brackets to 4 brackets, and it just simplifies the thresholds under which those rates apply. I don't want to go through all the different brackets. Those are, available to be viewed online or, at most of these websites summarize the bill. But they did simplify the amount of brackets and the thresholds to which they apply. Another major change is the standard deduction. Under the current law, it's $12,000 for married filing joint. That'll double. That'll go up to about $24,000 for those who are married filing jointly. Currently, it's $6,000 and change for individuals. That'll go up to $12,000. I'm assuming that most people are familiar with the difference between the standard and itemized deduction. Standard deduction is just the deduction or the lowering of your income by a standard amount depending on your filing status, as opposed to itemized deductions where you itemize your deductions such as home mortgage interest, real estate taxes, state taxes, charity, and other things, but those are the main ones. And anybody who does itemize is aware of the fact that under the proposed bill, many of the itemized deductions will go away. The biggest ones being state income taxes, and there's a limit on real estate taxes. If you're paying any more than $10,000 in real estate taxes, you can't deduct that. You can't deduct any more than $10,000. And in terms of home mortgage interest, any new mortgages being assumed over $500,000, the interest will no longer be deductible if it's over $500,000. Now, I don't believe that the entire interest won't be deductible, but just the interest on the amount that's over $500,000. Currently, the limit is $1.1 million. Any mortgage over $1.1 million, you can't deduct the interest on the amount of the mortgage over $1.1. And so obviously the real estate community and whether it's brokerage houses or agents or what have you are completely up in arms about this because it obviously hurts the real estate sales market. Another thing that's affecting real estate, which many of you have taken advantage of in the past, is the home sale exclusion on the gain on sale of a principal residence, the exclusion of those gains. So if you have a married person who sells their home and they've been in there for a number of years, then they can exclude up to $500,000 of those gains, and a single person can exclude $250,000 of gains. Now, that exclusion is available every 2 years. So if you lived in your house for 2 years, you sell it at a $300,000 gain, and you're married, you pay no taxes on that gain. And then 2 years later, if you do the same thing, again, no taxes on those gains. This would change that. Number one, there's a phase out of if you make over a certain amount, not all of the gain is excluded. And not only that, but you have to live in the house for 5 out of 8 years which is a major change in the rules. And obviously, again, the real estate market is not particularly pleased about that. Another major thing that's going away is we've had up until now an exemption amount, again, an amount that lowers your income, your reported income, for ourselves, if you're single, ourselves and our spouse, and our children, if we're married and have children. This past year was a little over $4,000 per exemption. So if you were married with 2 kids, that's 4 exemptions, you could take $16,000 off of your taxable income to arrive at your taxable income. That will no longer be allowed, those personal exemptions. To kind of offset that, the government has proposed increasing the child tax credit from $1,000 to $1,600 to kind of fill the gap a little bit. That is, I mean, those are the major highlights that affect, I mean, just about anybody, just about everybody, single, married, whatever it is, with children, without children. There are really, I mean, a lot of other things that affect many taxpayers, and I would encourage you to, you know, go again, like, to one of the more reputable or, you know, trustworthy websites, like whatever it might be, Bloomberg or CNN or whatever, and you know, just look at their summary, their highlights of the tax bill. And again, they're not going to get into the nitty-gritty that affect, you know, big corporate America or anything like that. They'll cover more or less what applies to you know, the 90% of taxpayers.
Great.
I mean, again, if anybody has specifics, if they've seen blurbs, you know, online or whatever regarding the proposed tax law changes that they would like to discuss or interested in, want more details on, you know, again, they can contact me about that as well.
All right. Well, Sam, I want to again thank you for your time. We really appreciate the knowledge. Great content, lots of different things to learn about. We've got your contact information still up here on the screen. Please feel free to reach out to Sam if you have any questions via email or calling his office. To give everybody an update, we have our last webinar for the year scheduled, and that is going to be, I believe, on the 14th. We're going to go ahead and do our HIPAA webinar, which is good old HIPAA. So December 14th, which again, we do these on the second Thursday of every month at 1 o'clock. And HIPAA is going to be a basic overview of things that need to be in place for any medical or dental practice as defined by HIPAA, called a covered entity. So we'll talk about that, how it relates to your dental practice, what you can do to make sure that you're working towards HIPAA compliance. And again, that will be on December 14th at 1 o'clock. Sam, thank you again. Again, lastly, this is going to be put up on our website. It usually takes about a week or so before we get it up there. Share this information out with your colleagues, with your friends. And again, reach out to Sam if you have any questions, but we thank everyone for attending, and we'll see you at the next webinar. Take care, everyone.
Bye-bye.